Welcome to the Deep Dive. We're the place that takes those dense earnings calls and makes them, well, make sense. Today we are digging into Texas Instruments. Their Q3 2025 results came out just after market close on October 21st.
Yeah, and this one's really interesting from a market reaction perspective. Because, look, the Q3 numbers themselves, pretty solid execution. They actually beat on the top line, showed decent growth. But the immediate reaction in after hours, not good. Clearly, investors were focused elsewhere.
Right, looking ahead, not behind. It's that classic forward-looking view. But let's touch on that rearview mirror first, because Q3 wasn't bad at all. TI brought in $4.74 billion in revenue. That was comfortably above the $4.65 billion consensus.
It was, and that's 7% sequential growth plus 14% compared to last year. Pretty robust.
Definitely a solid print on revenue. Suggests maybe that analog recovery we've been waiting for is, well, happening.
It does seem to be underway. But, and this is a big but, the costs tied to their strategic moves started hitting the bottom line right away. So GAAP EPS landed at $1.48, just a penny shy of the $1.49 estimate.
Okay, a near miss. Why?
Well, the key thing buried in there was a total reduction of 10 cents.
Yeah.
And 8 cents of that, 0.8 cents, was explicitly flagged as restructuring charges.
Ah, okay. So delivering growth, but also like tidying up the balance sheet or operations.
Exactly. But as you said, the market wasn't really focused on the Q3 beat. The stock got hammered because of the Q4 guidance.
Right. So what did they forecast that spooked everyone so badly?
Yeah, the Q4 outlook was, let's call it a reset. They guided revenue to between $4.22 billion and $4.58 billion. The midpoint there, it's below the roughly $4.51 billion the street was looking for. Basically suggests flat to maybe even slightly down sequentially.
Oof. After a strong Q3, that's not what you want to hear. And EPS.
Even tougher. The guidance was $1.13 to $1.39. That missed the consensus, which was around $1.41. So the message really was that even though Q3 saw broad recovery, TI is hitting the brakes a bit in Q4. External factors, internal strategy decisions, it all piled up.
Okay, let's unpack that Q3 strength a bit more before we get to the slowdown.
Yeah.
You mentioned broad recovery. Where did that 14% year-over-year growth actually come from?
Well, the core markets held up. Industrial, which is, TI's bread and butter, that grew about 25% year over year.
25%, wow.
Yeah, and even after a really strong Q2, they still managed low single-digit sequential growth. So sustained expansion there, even if it's moderate.
Okay, industrial strong, but you said broad-based. What else stood out?
The segments connected to data centers were really on fire. Enterprise systems jumped around 35% year over year.
35%, okay.
But communications equipment, that was a real star, up a massive 45% year over year.
45% in comms. Why such a huge jump there? What's driving that?
It's not just random growth, but it's tied to that need for sophisticated analog chips, power management especially, the 5G rollouts, fiber deployment, and importantly, all the AI-related data center stuff. Switching, power solutions, that's where TI's R&D focus is really paying off.
Makes sense. And automotive, usually pretty steady.
Yeah, automotive was up upper single digits year over year, so still growing, just not as explosive as comms or enterprise.
Okay, so operationally, handling this Q3 volume, did margins take a big hit?
They actually held up pretty well. Gross margin was 57%. Okay, it was down 50 basis points from Q2, but still strong. Operating margin at 35%.
And inventory, that's always a key metric in semis.
Right, and this is interesting. Inventory days actually dropped, sequentially down 16 days to 250.
Okay, why is that drop significant?
Well, it suggests that maybe those customer inventory depletion cycles are, finally working through. The channel might be getting cleaner.
Gotcha. But let's circle back to those costs you mentioned, that 0.8 cent restructuring charge. You said strategic moves. What's this 150 millimeter to 300 millimeter thing about?
Yeah. This is the long game for TI. That charge is directly related to them winding down their last two older fabs, the ones using 150 millimeter wafers.
So they're closing old factories.
Pretty much decommissioning them. This shift to 300 millimeter wafers, it's a huge deal economically. You get roughly 2.5 times the chips per wafer. It's a massive cost advantage down the line.
So that 8 cent charge is basically the cost of speeding up that transition, even if it dings earnings now.
Exactly. It's a calculated investment in future manufacturing dominance. It hurts near-term GAAP, but strategically.
It puts their spending into perspective then. Their trailing 12-month free cash flow was, what, $2.4 billion?
Right. but capex was $4.8 billion.
So they're spending way more than they're generating right now, intentionally.
Absolutely intentionally. Building out that future capacity, those big new fabs, it's part of that multi-year, multi-billion-dollar plan. They're prioritizing the long-term structural advantage over short-term free cash flow.
And that spending, that strategy, ties directly back to the weak guidance.
It leads us right there.
Yes, management said the recovery is happening, but at a very moderate pace. They also said customer inventories are low, depletion's mostly done, so if the channel's clean, why the soft Q4?
Because if the recovery is only moderate, TI has its own inventory to worry about, especially with the new 300 millimeter capacity coming online. They need to manage that. So their answer, they explicitly said they are lowering fab loadings in the near term.
Okay, explain lowering fab loadings for us. What does that mean practically, especially for margins?
It means they're deliberately running less volume through their factories, reducing utilization. Factories have huge fixed costs, right? Power, maintenance, staff. Those costs stay pretty much the same whether you're running full out or at half speed.
So lower utilization means higher cost per chip.
Exactly. Those fixed costs get spread over fewer units, unit costs go up, margins come down. That depressed utilization is the main intentional reason for the Q4 margin pressure and the soft guidance.
They're choosing inventory stability over short-term profit margins.
Precisely. Sacrificing near-term efficiency.
And connecting this to the wider economy, management also pointed fingers at some external issues, especially hurting the industrial side.
Yes, and they were surprisingly direct about it. They explicitly linked the ongoing uncertainty around tariffs and trade policy to weak industrial capital expenditure.
How so?
Basically, industrial companies are holding back on buying big new machines, building new infrastructure, the stuff that needs TI's chips, because they don't know what the final costs will be or, frankly, where they should be building things globally due to trade rules.
So that moderate recovery isn't just the economy, it's also geopolitical hesitation.
It feels like it. That uncertainty is hitting TI's core high-margin industrial market directly. It just kills the predictability investors want.
Any bright spots in the guidance, aside from just setting a low bar?
Well, there was one small positive baked into the Q4 numbers. The guidance did include a new, lower effective tax rate, around 13%, thanks to some recent U.S. tax changes.
Okay, so a little tax relief offsetting some of that margin pressure from lower utilization.
A little bit, yeah. Every little helps, I suppose.
Which brings us back to this core conflict, right? Management keeps talking up free cash flow per share growth as the ultimate goal, justifying billions in capex. But the market right now, it's punishing them for the immediate pain, the low utilization, the margin squeeze, and TI stock was already lagging the semiconductor index, the SOXX, even before this call.
Yeah, the underperformance is already there. Set a pretty low bar for good news, which they didn't quite deliver on the guidance front.
So what could actually change this negative narrative? What catalysts are investors looking for?
I think the market needs proof that the big strategy is actually starting to pay off, sooner rather than later. So catalyst number one, seeing sustained strength beyond just those data center areas, we need what they called an upward inflection in loadings or backlog linearity, basically orders picking up faster than moderate.
Okay, real demand acceleration. And number two seems obvious.
Policy clarity. Absolutely, especially on trade and tariffs. If that gets resolved, it could unlock a wave of stalled industrial orders.
Makes sense.
Yeah.
What else?
Third, tangible progress on the big fab projects. Hitting milestones for the 300 millimeter ramps in Sherman, Texas and Lehigh, Utah, showing that multi-billion-dollar investment is on track.
Right, the physical proof of the strategy.
And maybe fourth, a smaller point, but the governance transition gets finalized in January 2026, when the CEO, Haviv Ilan, also takes the chairman role, just solidifies the leadership continuity behind this long-term plan.
So it really feels like this near-term margin pain is just the price they have to pay for that long-term manufacturing.
Just the calculated cost, yes.
Okay, given all this, the intentional slowdown, the market reaction, the uncertainty, where does this leave someone maybe looking for a short-term trade?
Well, that leads us perfectly into our segment, This Is Not Financial Advice, where we kick around an idea, maybe a bit out there, but plausible based on what we just heard.
All right, standard disclaimer applies, everyone. This is purely for discussion. Let's hear the outrageous but plausible trade.
Okay, so the key tension, right, is that intentional hit to utilization. Management is choosing to lower loadings to stabilize inventory now. The market hates the immediate margin impact, sure. But by taking control, TI is arguably reducing the risk of a much bigger, messier inventory blow-up later on.
So you're saying the bad news is kind of managed bad news and maybe already priced in after that initial drop.
That's the angle, yeah. So the trade idea isn't betting on a quick rebound. It's actually betting on stability, or rather lower volatility going forward.
How would you structure that?
It would be something like a short volatility trade, maybe selling near-term out-of-the-money puts.
Selling puts. So you collect premium betting, the stock won't fall much further from here.
Exactly. You're essentially selling insurance to other investors who are still worried about a bigger drop. The rationale is that TI's underlying execution in Q3 was decent, their long-term focus is clear, and they've proactively managed the near-term inventory risk by lowering loadings. A catastrophic collapse seems less likely than that initial 7-8% knee-jerk reaction might suggest. The bet is that this cautious, controlled guidance actually removed some uncertainty about a future inventory glut.
So the floor is in or close to it, and volatility should settle down now that the Q4 shock is out.
That's the plausible argument. Once the market digests this controlled utilization dip, volatility might contract, and those puts you sold expire worthless. The cautious guidance becomes the anchor point, strangely enough.
Interesting. Selling puts because management took control of the downside, in a way. Okay, let's recap this Texas Instruments Q3 deep dive. Strong Q3 revenue beat, driven by data center and comms, but a Q4 outlook that missed expectations, calling for a more moderate pace.
Yep. Citing that trade policy uncertainty for industrial, and importantly, their own decision to lower factory utilization to manage inventory.
And that intentional margin hit is what really drove the stock down after hours.
It's the whole story right now. A company absolutely committed to a massive, expensive, long-term manufacturing upgrade. They're prioritizing that multi-decade free cash flow per share goal over hitting every quarterly utilization target. It forces you, as an investor, to pick a side, short-term pain or long-term gain.
Which leaves us with a final thought for you to consider. We know the analog chip business has incredibly long investment horizons. So how much longer can TI keep pointing to that long-term FCF growth while delivering, bumpy near-term results and guidance before the market truly buys into this massive $60 billion capacity vision?
Yeah, when does the long-term finally become the present? Something to think about.
We hope this deep dive gave you some valuable insight into what might come next for TI as everyone figures out this inventory situation and that huge capacity build-out.